About that all day yesterday.
"23 seconds away from the opening bell. Good morning to you all. This morning we're positive by just about 0.1% on the S&P, on the Russell up by 0.2, on the Nasdaq down by 0.3% or so. The story's not here, it's in the commodity market. The opening bell in New York City rings. Switch out the board and get to the commodity market. Crude looks like this. WTI 125 up by 5%. The president speaking, set to speak, scheduled to speak at 10:45 Eastern. I laugh because you never know. That's meant to be 1 hour and 15 minutes away. Typically he turns up a little bit late. We've got a preview from the team down in DC. The president expected to announce a ban on Russian crude imports. Look out for that. Euro positive, euro dollar 109. They could make that move without European allies. The euro stronger off the back of a report from us here at Bloomberg that we could have a joint debt effort again to fund defence and energy on the continent. I'm sure Guy Johnson's going to be talking about that in about 30 minutes. Yields are higher by 8 basis points to 185.77 on 10s going into CPI this Thursday. That's the cross-asset price action with your movers at the open. Here's Abby.
John, well, sticking with the oil story, the natural resources boom, this commodity move that we're seeing, just really incredible right across the board. Oil in particular, very strong. The energy complex is up and away, especially some of the refiners, including Valero and HollyFrontier. But it's interesting, John, we also have a bid for alternative energy. The likes of Sunoco and Plug Power also higher on this morning. Interesting, taking it to another leg, you would think that this would impact travel in a negative way. The rising cost of jet fuel, we've certainly seen that. But today we actually have strength for travel. So we have this strange tension between this energy crisis and the desire to reopen today. The desire to reopen relative to travel is working, but energy, as you know, the top sector in the morning.
Big time, up 2% around the opening bell, about 35 seconds in. Your equity market is flat. Move to the downside on consumer discretionary. You might expect that. We're down by 0.6% for that industry group. Looking at crude close to 130. Let's get more with Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, with commodity prices this elevated, it feeds into fears of inflation, which actually is now morphing into fears of stagflation. You see that reflected a bunch across a bunch of, if I can get my words out, different assets. One of them being, of course, the yield curve is what we look at, which has been consistently flattening over the last year. That gap between 2- and 10-year yields now sitting around 26 basis points, which actually is even a little steeper than where we were yesterday, but still is about the flattest, going all the way back to March of 2020, which of course is the height of the pandemic recession. And that basically indicates that concern, that the idea that policy is going to get too tight and choke off growth down the line. And of course you have the yield curve, you have higher commodity prices, you have stocks that have been selling off, all of that fueling the fire around concerns about recession. And just to linger on stocks for a moment, I wanted to point to this from Citi. Global earnings revisions are actually in negative territory for the first time since September of 2020. So more net downgrades than net upgrades to forecast. The strategists there saying that is a game changer as it removes fundamental support just when liquidity is also about to be sucked out by central banks. So in that kind of environment, where do you put your money, John? Usually in periods of stagnation, it's defensive stocks that tend to outperform, and that is definitely what we have seen over the last 2 weeks. When you remove energy, because that is far and away the outperformer for obvious reasons, thanks to the oil price, the other top performing sectors in the S&P 500, utilities, real estate, healthcare, all of which are defensive sectors, John.
Kaylee Lyons, thank you. The team over at Citi using that word, stagflation. The S word reads as follows. Concerns are rising as the fallout from the conflict in Ukraine threatens to weaken economic growth while lifting inflation. The recent sharp drop in real yields means growth strategies should do better. We have a preference for growth over value with some mild cyclical tilt with value. Let's pick up on that word stagflation and get to the team. Francis Donald, Julie Bill, Savita Subramaniam. Julie, do you subscribe to that? Is that a framework to explore stagflation?
Absolutely. I think the problem that we have right now is higher oil prices mean that there is likely going to be more aggressive Fed action. But I think the true question is, does this lead to demand destruction? And we can go back historically and see all of the periods where oil prices rose dramatically, and you see meaningful demand destruction. And since the since the U.S. economy is generally a consumer economy, it has meaningful ripple effects throughout. For us, we would pay attention to, smaller mid-cap software names that have high levels of recurring revenue, durable earnings growth. I think those are the places to hide out, and I would call them your comfort stocks.
Can you talk to me about banks as well? Julie, we're talking about higher rates, and yet banks have backed away. We're talking about higher energy prices, yet at the same time we're also considering what may or may not happen with energy equities as we start to explore demand destruction a little bit more. Julie, what do you think all this means for the banks at the moment, which are very much on the back foot year to date?
I think it's been interesting. We had all assumed that the higher interest rates would translate into higher prices for the banks. And I think if you look at the mega caps, that hasn't really panned out, partly because I don't think their exposure to that is so strong. Your smaller banks, they have more of an impact from a rising rate environment, but they have converse effects as well in terms of, is there going to be more lending if interest rates rocket higher? So much of the smaller banks have been benefiting from a really strong housing market, and that may disappear over time.
Down 12% year to date coming into today's session. I think the lowest in more than 12 months. Savita, where do you stand on the financials, on the banks more specifically?
Look, we're overweight financials, and I think that the sector has, as Julie rightly pointed out, this sector, especially the large cap banks, are not necessarily as impacted by the yield curve, by rates. I think this is a source where you still have relative value. You have a sector that has basically de-risked after the crisis. The leverage ratios are at close to all-time lows. Even during the global pandemic, you saw earnings of the banks remain relatively, stable versus other cyclical sectors. So I think that this is kind of fits in with our quality income theme. I personally think we're going back to a time where we're going to buy bank stocks for the quality and the dividend yield rather than this levered bet on housing, which was the story in 2008. I think the sector has transformed itself. I think the other kind of theme for banks and energy is that they are still, despite their strong performance over the last 12 to 18 months, these are still very underweighted sectors by the buy side. So I think that there is less crowding risk within banks and energy than there is within some of the growthier areas of the market like tech, TMT, et cetera. So I would stick with financials. I don't think that they're necessarily hurt by, a flattening yield curve. We've done the math, we've done the work, and we haven't necessarily seen this strong relationship between yield curve and financials companies. So I think it's a sector that's unloved, still relatively inexpensive, and much higher quality than it has been, in prior.
Savita, when you say you've done the work, do you mean you've done the work on what the yield curve means to profits, or you've done the work on what the yield curve means to investor attitudes towards the group of equities? Because what I often find is that the bank analysts on the single names will tell you what actually matters to the banks and profitability is not where the 10-year yield is at. But for a lot of people in the broader market, it shapes their attitude towards allocating money to the financials. So does it matter, doesn't it matter, and what does it actually matter to?
That's a great point, and I think therein lies the opportunity. If the macro folks and the generalists are getting it wrong, and the banks are actually moving and generating profits on different factors, I think all the more reason to really step in. And I think that one of the issues that's been created by this sort of macro focus is we can trade ETFs and sectors really easily now. So the financial sector has moved in lockstep with the yield curve, whether it should or shouldn't, because of this investor sentiment. Again, I think this is a great time to pick stocks, and I think what we need to do now is the work of listening to the fundamental analysts and figuring out where the macro folks are getting it wrong. I'm a macro person, but I know that a lot of these relationships that we've tested that seem like they would work don't necessarily work.
Frances, your world, are the macro folks getting it wrong?
Some are. I think it's funny that we hear concerns about stagflation are starting to rise. It's too late to start getting concerned about stagflation now. We're already in stagflationary dynamics. Q1 GDP tracking at 0%, and CPI is going to hit an 8 handle this week. Now is the moment where growth is going to be too low relative to comfort and inflation too high. But how do you translate that? And that's why we need people like Savita and Julie, because even we have looked at past cycles and said, well, yes, every recession is preceded by a huge jump in energy, but we're in a different environment where energy is less of the consumption basket. Twos, tens are on the brink of inverted, but is there an adjustment that needs to be made for the term premium, or is the Fed's buying creating distortionary impact? So I think macro folks generally can get it right, but that doesn't mean they know to necessarily translate that to the trade. And that's why, even as a macro person, it pains me, we always need good people to pick good stocks.
Francis, can you talk to me about the yield curve? Seemingly the only two people that talk to me about the yield curve at the moment is my friend in the bow tie and my friend Bramo waiting for the apocalypse. Now, I want to understand, Francis, why no one brings that up anymore. You've identified the same thing. Typically, when you get to about the 20s, it's all I'd see everywhere. Now people don't talk about it as much. Do you experience the same thing?
Well, absolutely. In 2019, 2018, it was all anyone would talk to me about. There might be a few reasonable reasons for this. One is that we're not seeing the same level of inversion across the entire curve. So, for example, the longer end is not inverting so much with the 3-month. So that gives us a little bit of a pause. Second, we understand there are distortions with the yield curve. But just take a step back and look at this. We've been flattening for over a year. This is a market that is saying the Fed is going to have to respond to stagflationary dynamics, which means they're not going to have any cover to pivot, which means that front end is going to have to rise, and we have not seen ourselves exit into escape velocity for the long end to come out. A lot of that, I think, is also fiscal being reflected. We didn't get game-changing fiscal, and we haven't seen game-changing productivity. So all the macro factors that would drive that long end higher have not materialized. That's very unlike what we thought would happen when COVID first hit, and we thought it would be a game changer for long-run growth.
The twos tens closed out 2021 at 77 basis points. Twos tens right now at 27. Judy Bill, you get the final word on this one. The final word, please.
Well, I think if you look overall at the economy, the risks are definitely towards the downside. And for us, as longer-term investors, we're looking for the quality businesses, ideally businesses that have been through these types of cycles before. And so it's a great time to be a fundamental investor, to actually look at the earnings. So many of these stocks have been beaten down indiscriminately, and I think it's a real opportunity for those who are looking at quality.
Do we really have to wait for International Women's Day to do this panel every day? Can we just do that, Monday to Friday? If you find an hour for me every day around 9 Eastern, we'll continue to do so. Francis, thank you. Savita, to you as well, and Julie. What a lineup. Fantastic. Thank you very much. About 11 minutes into this session, equities pull back 0.2% on the S&P 500. Crude approaching 130 on Brent. Coming up, Secretary Blinken setting the stage for sanctions on Russian crude.
With regard to a potential oil embargo, an embargo on the importation of Russian oil, this is something, as I mentioned, that we have been discussing within the administration.
That's next. This is Bloomberg.
with regard to a potential oil embargo, an embargo on the importation of Russian oil. This is something, as I mentioned, that we have been discussing within the administration. The president discussed this as well yesterday when he had a call with the French president, British prime minister, and the German chancellor, and something we're very much actively looking at.
As we know, the Germans have said no. They said that yesterday. And what we've learned this morning here at Bloomberg is that the president is set to announce a ban on Russian energy. Europe won't be joining them. Julian Lee joins us now for more. Julian, I want to get you on a headline I've just seen from Germany that takes us to the other side of the story. We'll be focused almost exclusively on what a ban of Russian energy into the United States means for the oil market. And we can touch on that in a moment. But Germany just said this. Germany is prepared for Russian energy curbs. Julian, I don't think we've quite spent enough time considering what the reaction to the action we're about to see will actually look like from the Russians.
Yeah, I think this is going to be, a big part of the picture. Everybody's been talking about how Europe and the US should impose sanctions on Russian oil exports, potentially on Russian gas supplies. But relatively little has been said about how President Putin may react to even initial sanctions on oil supplies. And obviously his biggest weapon in that sphere is gas exports to Europe. And I think you have to factor in the possibility that he would retaliate by closing down the pipelines that bring Russian gas into particularly into Germany, but into many other European countries as well.
Julian, this gets messy and potentially messy very quickly. Can you work me through piece by piece just what we know so far, based on our reporting? Based on our reporting, we'll get this decision from the president. He speaks in about an hour from now. A decision to ban the import of Russian energy. Europeans don't go with them. Is that just moving the deck chairs a little bit? Does the US go somewhere else for crude and Europe ultimately stays with Russia, maybe takes a bit more of it, China comes in? Does it really change anything?
I think firstly, I think it sends a very important signal that those who can will clamp down on purchases of Russian oil, gas and coal, which I think is what the Biden administration is talking about, all three sources. Now, obviously it's much easier for the US to do that than it is for European countries. We might see some other countries in Europe taking similar positions. I mean, it's quite possible that the United Kingdom might follow suit. We here are much less dependent on Russian supplies than some of our counterparts on the continent, and there is this possibility of chipping away. But as you suggested earlier, the retaliation to that might be a very rapid escalation from the Russian side. Now, that's not cost-free. Yes, Russia may be able to divert at least some of its oil exports elsewhere, but the only way that it would be able to do that is to put that oil on tankers, either in the Black Sea, if the tankers will go to Russian ports, or in the Baltic, and then ship them a very long way round to China or anyone else who will take them. That's going to add massively to the cost and the time it will take to deliver them. For gas, if he doesn't ship his gas to Europe, he's not going to be shipping it anywhere because the big gas fields that supply European markets aren't linked to pipelines that will take that gas anywhere else. So for him, yes, he can cut off those supplies, and he may calculate that will do more damage to European buyers than it will to Russia, but he can't divert those gas flows anywhere else quickly.
Just got a headline, Julian, that the UK is to announce a ban on Russian oil imports as well. Clearly, for Europe, this is an important issue. For the EU, for the Germans, for the French. For the US, less so. Where does the UK fit in, Julian? Just their dependence on Russian energy?
I think it clearly fits between the two. We take relatively little energy from Russia. There's quite a big presence for Gazprom trading in the UK, but that's typically trading gas that it gets from elsewhere rather than molecules that actually come from Russia. For oil, it's a little different. There was a case of a tanker full of diesel fuel that unions said that they wouldn't unload earlier in the week or at the end of last week. We do take supplies of Russian fuel. We do take supplies of Russian crude oil. We are going to have to replace those from somewhere, and it could get quite tricky. The diesel market in Europe is already pretty tight, and so cutting off a significant source of supply in Russia is going to cause difficulties. But it's something that I think has to be done. The worst situation we could possibly put ourselves in is the one that we seem to be in at the moment, which is continually threatening that we might impose some sort of sanctions, which then forces prices up. But by not actually doing it, we're simply paying more for every barrel, every cubic meter of gas that we buy from Russia, and we're filling the coffers of the Kremlin.
Julian, that's the story of the moment. It's become almost a moral obligation to pull back. It's no longer about what it was just a couple of weeks ago, which was about hurting their economy without hurting our economy. They being Russia and us being the UK or the United States, for instance. Now it's about a moral obligation. That seems to be the perspective shift that we've seen from the US administration and others. Do we have a moral obligation to pull back from Russian energy? Julian, thank you. Just to run through those UK headlines. So this is it. The UK to announce a ban on Russian crude imports. The ban on Russian oil to be phased in over months. Won't happen immediately. The UK decision will not affect Russian gas imports. This according to an official in the UK. So I'll go through that again. The UK to announce a ban on Russian oil imports. It will be phased in over months, but it will not affect Russian gas imports. That's according to an official. That last piece of information, I think, is really, really important. What it will affect, what it won't affect. And if we get a US decision a little bit later today, listen carefully to the language. What is it? Energy, all of energy, including crude products, just crude, liquefied gas and coal. That's what we want to hear from the President for just a little bit later. The President of the United States speaking within the next 60 minutes or so from New York. This is Bloomberg. 25 minutes into the session, expecting to hear from the president at 10:45 Eastern Time. The US set to impose a ban on Russian energy after the UK makes a move to do something similar. Futures look like this going into the open all over the place, and now about 25 minutes in, the S&P 500 cash story is down 0.2%. That's the equity market. Here's the trading diary. The President of the United States discussing actions to hold Russia accountable for its invasion of Ukraine at 10:45 Eastern. Secretary Blinken meeting with French President Emmanuel Macron at 12 p.m. The Treasury selling 48 billion in 3-year notes at 1 p.m. US CPI coming up on Thursday, looking for something close to 8% on inflation. Shortly thereafter, seconds later, you will hear from the President of the ECB in a news conference. 45 minutes before that, you'll get an ECB rate decision. Finally, to close out the week, UMich Consumer Sentiment Survey coming up on Friday. The focus this morning, very much on the energy market, with Brent at 131, approaching 132, with the President of the United States speaking a little bit later. From New York, this is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Tuesday, March 8th. Here are the top market stories we are following for you at this hour. Here come the embargoes. The Biden administration is set to impose a ban on Russian energy imports as soon as today, with the president expected to speak later this hour. The UK is preparing to announce a similar ban on oil, but not gas. Bracing for the fallout, the EU is considering issuing joint bonds at a major scale to finance energy and defense spending and blunt the impact of Russia's invasion of Ukraine. This after the Kremlin's threat to cut off gas flows from Nord Stream 1. And like a meme stock, nickel spikes an unprecedented 250% in a massive short squeeze, forcing the LME to halt trading and leaving a Chinese tycoon facing billions in losses. We'll have more on the actions in metals with Andrew Forrest of Fortescue. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, happy Tuesday. It is commodities and energy front and center.
Absolutely. We're going to hear from the president a little bit later on in the show, 10:45 in theory. We'll see exactly when it happens, in theory. But it's interesting, Kaylee, that we find ourselves in a situation where parking the UK to one side and its partial potential ban on Russian energy, it is the US going it alone. Europe can't deal with this. And the second headline you read out there talking about the fact that Europe is looking maybe to issue significant numbers of joint bonds to A, rearm, and B, deal with the consequences of this energy story, I think is highly significant. Europe is in the crosshairs of this story, and the economic impact, I think, is at this point really hard to gauge. It's interesting that economists at this point are not downgrading their economic forecasts. I checked the winter forecast from the European Commission a little bit earlier on. The last one was a 2022 growth of 4%. What's the downside potential on that number? Is it now inevitable that Europe is going to be facing some kind of a recession? So that brings us to our question of the day, and we're trying to analyze exactly what is happening with prices right now. Are investors correctly pricing European risk? To try and answer this question, we bring in Karen Ward, JP Morgan's chief EMEA market strategist for JP Morgan Wealth, and Bloomberg's Justina Lee. Justina, let me start with you. Economists are probably racing to catch up on the implications of what is happening here for the European economy. Highly exposed to Russian gas prices, energy prices going through the roof. Just about everything in terms of the commodity space moving up and up very sharply. Do we yet have a handle, do economists yet have a handle on understanding and then pricing the economic downside here?
I think not yet. I mean, we've seen a huge reaction in equities. You know, the Stocks Europe 600's valuation is now the lowest since the depths of the pandemic. But, you know, if you're still looking at sell-side forecasts, the GDP forecasts have only been downgraded very so slightly. And I think it's especially hard to grapple with, given that shortly before the invasion, the narrative was all about the recovery from COVID. And so it's really been a very sharp change from that story.
It has indeed been sharp. So, Karen, to bring you in here, how has your view of Europe changed in the last 2 weeks?
Well, I mean, significantly, as you say, if we are faced with an absolute stop in supply of gas, then for certain industries, and I think there will be just a technical, if nothing else, stop. So these are, you know, those industries, steel, etc., that rely on these raw materials. For the broader economy, you know, the upside is we did come into this crisis with consumers in very good shape, high levels of savings, the jobs market very good, wages pushing up. The critical things to watch right now are to what degree are governments willing to absorb this cost. We've seen in the pandemic that if governments are willing to use their balance sheet, that can be very significant in insulating the private sector. So the news this morning that Guy pointed to is very significant. I think we're going to see a swathe of action, not only to try and shift energy sourcing and energy efficiency and move away from dependence on Russian imports, but a whole suite of packages that will support the consumer. The other thing that Europe has is a central bank which is under no pressure with regards to inflation, and they can provide support. We're going to hear from them on Thursday.
I'm looking forward to going to Frankfurt to hear from Madame Lagarde. Karen, the ECB's mandate, though, is inflation. And if inflation rips higher in Europe, that's going to cause significant economic damage anyway. The consumer is definitely in the firing line here. Sure, the government spending may sort of blunt that, but this is a short-term, near-term impact the consumers are going to feel. It's food prices. Is the government going to support those? It's energy prices. Well, we may see some action there, but is it going to be complete? The consumer in Europe looks like it is facing a number of different really difficult problems at the moment, and I'm wondering whether or not that's enough to bring down growth forecasts from circa 4% now down to 0 or potentially below that.
I definitely think 4% growth is not going to happen. As you say, those forecasts are now too old. Don't forget the market, though. There's a real distinction between economists' forecasts and the market. I think the European markets, now down 14, 15%, are already pricing a mild recession. So whatever happens to the economists' forecast, I think the actual stock markets are already there. I agree. I don't think governments are going to absorb the full cost of that, but I think they will insulate lower income households, the bottom half of the income spectrum, and then the upper half of the income spectrum have been saving because they haven't been allowed out for the last 2 years because of the pandemic. So I don't think that this is, a real wage catastrophe. I also think that we have to remember, because there's so much reflection on the 1970s, that we've been through many periods in the past where real wages have been squeezed or falling, and it hasn't given us a recession. What's given us a recession is when the central banks worry about inflation, slam on the brakes. I don't think we're going to hear that from the ECB. I think they're going to say, we can't bring down energy prices by raising rates. That's going to slow the economy. We're not going to compound the problem. We'll hear reassurance from them, and they'll be supportive.
Okay, well, Justina, I'm taking a look right now at oil prices reacting to all of this news, up more than 7% on both Brent and WTI. Brent at 132, oil at 128. Clearly all of this kind of fueling the inflation or stagflation narrative. Where in the market does the greatest repricing need to happen for a kind of recession scenario, or is that already starting to be priced in?
I think we're definitely starting to see that, in equities and obviously, after such a sharp move in commodities. I was reading kind of a note from Bernstein just then, and it pointed out something really interesting, which is that we haven't really seen a drastic flattening in the European yield curve yet, whereas we've actually seen that in the U.S. So that would seem to indicate that for whatever reason, in terms of the yield curve, the expectations are not that pessimistic just yet.
Is the yield curve a real reflection of reality here in Europe, given the involvement of the ECB at such a high level?
Yeah, I mean, that is a great point because, I guess in the U.S. what we've seen is, people were expecting the Fed to raise, and so the short end kind of went up, but the long end didn't go up as much, and hence there was a lot of flattening. But in Europe, we kind of haven't seen that yet, and maybe some of that has to do with, different expectations for the ECB.
Clearly, Karen, when we came into this year, we thought the picture was going to look a lot different. And one of the consensus calls was Europe over U.S., those value trades over growth. Does this situation present potentially now the reverse of that, where Europe may underperform and growth actually could play a role again?
Right now, but I do think we need to be careful about getting whipsawed here, because if there is some degree of resolution or at least a moderate de-escalation, we're going to be in a position where many of those earlier narratives could actually be accelerated. We've got more inflationary pressure into the system. We've potentially got the central banks having to therefore tighten by more if the recovery then gets going, and this is not a recession and a growth risk. And it was really the rates story that was driving that rotation. It was the prospect of higher interest rates, steeper curves, supporting the financials, perhaps being at detriment to some of the growthier, the tech areas of the market where rising rates have not proved so supported. There's been headwinds to those valuations. So I think we should be really careful about today, given the moves that we've already seen, getting whipsawed by actually shifting positions materially, pro-US over Europe, for example, because if we do get to a point in 6 weeks, 2 months' time, we could be right back to discussing, all of the central banks having to catch up.
But how much damage could still be done, Karen? Let's go back to the starting question. Are we realistically pricing the risk of what is happening here? Are markets functioning properly as a balancing mechanism, risk and reward? We have so much uncertainty. It strikes me as that is incredibly difficult at the moment. How much damage can be done between now and then? What's the strategy between now and then in terms of managing a portfolio? Do you just sit tight? Do you just not do anything? Or do you actively have to reposition around this?
You want more moderate risk position, absolutely. I mean, as we say, the beginning narrative was these economies are so strong, the central banks are behind the curve. You didn't want government bonds in that environment. You wanted to be heavily overweight equities and short government bonds. That's not where you want to be today. You definitely want a more moderate position. You want to be thinking about your ballast. You want to be thinking about dollar, gold, treasuries at the moment, for all the while central banks are doing what I suspect, which is offering supportive comments to supporting gold, they are going to prove the ballast. So you definitely want to be thinking, but I just think given the moves that have already happened, if you were to today think about, okay, well, I was positioned pro-Europe and over and underweight the US, switching today at today's prices may not then be the right thing, given the prospect of that return of the earlier narrative of inflation and rising rates, in which case, and as I say, that rotation was very much about tech financials, value growth, and that was what was driving the regional rotation.
Well, and obviously part of the rotation as well is about relative earnings performance, Justina. And I was reading out of Citigroup earlier, net earnings revisions are actually negative now for the first time since September 2020. Is this market prepared for a potential rollover as well in corporate profits and that support going away?
Right. I think we really have to think about, the shock that's come from this invasion, because on one hand, you have companies whose input prices might depend on commodities. And on the other, for a lot of consumer discretionary companies, the hit to consumer spending really could be a hit to that bottom line. And that's why we're kind of seeing valuations come down so rapidly already.
Yeah, one area that we're certainly not seeing profitability proving to be a problem is the energy sector. Karen, do you think ESG is stopping people investing in the energy sector right now? It is having a huge impact on people's performance, portfolio managers' performance. Do you think that is a factor at the moment? And to your earlier point about has the move already happened, would it be dangerous at this point, given the potential for huge amounts of volatility going forward, to invest in the energy sector?
Yeah, the two different questions there. Let's put ESG aside for just one moment and just think we do have to be very careful when we get to very elevated commodity prices and energy stocks have done terribly well. We have to remember that at some point, high energy prices themselves destroy their own demand. And therefore, as recession risks rise, that's why you tend to see in historical cycles big pickup in energy prices, but then big declines. So as we get higher, 130 now, I think actually allocating more to energy doesn't look an obvious trade to me. You want to be thinking, as you're talking about, that demand destruction really becoming the dominant theme. I think on the broader ESG front, to me, the one thing we can say with absolute conviction today is the momentum behind transitioning our energy policies to different sources and dramatically different energy efficiency. That was a 2050 ambition. It's now a winter 2022 ambition. The game has changed completely. The resources that will be thrown at this will be tremendous. That's an area where I think we should have absolute conviction about deploying capital.
All right, Karen Ward of JP Morgan Asset Management, thank you so much for joining us, and thanks as well to Bloomberg's Justina Lee. And coming up, we're going to talk more about that transition that Karen was just talking about, the implications of an oil embargo on product imports coming from Russia, what that may mean for whether or not that transition needs to be accelerated as well here in the U.S. Of course, we're waiting to hear from President Biden preparing to take the next step in punishing Moscow for the invasion of Ukraine by banning those Russian oil imports. It's a story Bloomberg's Anne-Marie Horton broke last week. Details next. This is Bloomberg.
Russia invades Ukraine.
We have proven our strength.
The nature of this war changed yesterday.
Turn to Bloomberg for up-to-the-minute reporting from around the world.
Ground troops are closing in on the Ukrainian capital.
Swiss abandon neutrality. And analysis of what it all means to you.
Energy is on the table.
We could see oil prices moving closer to 120.
There is a lot of interest to offload Russian assets.
Look to see more companies announce their exits from Russia.
Keep it tuned to Bloomberg Television and Radio.
Not long from now, the Biden administration is set to ban imports of Russian oil and other forms of energy. We are expecting to hear from the president later on this hour. Anne-Marie Hordern was one of the Bloomberg reporters who broke this story, and she joins us now from Washington. So, Anne-Marie, we understand that the UK is moving to make a similar ban on oil imports from Russia. The EU, though, it looks like the administration may be acting, if not in defiance, not in coordination with. Is the Biden administration assuming that the rest of Europe will follow its lead?
Well, at the moment, they've been talking to the European Union, but I spoke to an EU official very early this morning who said Europe's just not there yet. And I don't think the world expects Europe to be there. I mean, if you just look at Germany alone, they are heavily, heavily reliant on Russian fossil fuels. Now, Olaf Scholz said yesterday they want to loosen that dependence on Moscow, but it's not going to happen overnight. So you do see movements in Europe to try to move to renewables, building more LNG facilities, but it just cannot happen right away. But what we do know is that the administration has been consulting their European allies. So while they are making this decision unilaterally without them, and it comes on the heels of Canada, we have reporting that the UK will be next, Europe will not be alongside them in this ban.
AMH, what is going to replace this oil? I'm always surprised at how much the United States does import. Vicky Hollop just been talking over the last few minutes, the Oxy CEO, saying that U.S. oil drillers cannot significantly expand output. What fills the gap?
Well, over the weekend, we did have U.S. officials in Venezuela. Potentially, they can fill this gap, especially you look at the grades of crude. What comes from Russia is a very heavy, thick, high-sulfur, viscous grade. Potentially, Venezuela could fill that gap. Now, there's an embargo on Venezuelan crude. Venezuela has the most proven oil reserves in the world. Potentially, this is an opening. Then, of course, there's talks of an Iranian nuclear agreement. Hossein Amir-Abdollahian, the foreign minister of Iran, has been very optimistic in Iranian press coming out of Tehran that there could be an agreement. Potentially, Iran could fill some of this. And then, of course, there's the U.S.'s ally in the Gulf. That's the Kingdom of Saudi Arabia. So far, they have not been willing to act. Potentially, does that change? I would say these are the three countries that could potentially have a little bit more of an immediate impact on the crude market.
Speaking of things that could fill the gap, Anne-Marie, what about renewables? And how does this potentially relate to spending out of Washington? I noticed Jan Hatzius over at Goldman Sachs publishing earlier today. This is part of what he said. He said the odds of some form of renewable legislation passing has risen. The impact on energy prices from recent events and the importance of energy considerations and sanctions discussions could motivate lawmakers on both sides of the Atlantic to accelerate the shift to renewable energy. Anne-Marie, is this in some backwards way a way of the president getting more of his climate agenda and the spending that comes with it through Congress?
It's a great point. I imagine the president, when he takes the podium today at 10:45 a.m., he's set to, that this is what he will lean into. He ran as a climate president. He wanted to transform the grid of America and where and how we heat our homes, fuel our cars, etc. So this would likely be something the administration, and they have already been talking about this, more money towards renewables. And when you looked at his Build Back Better legislation, climate was actually one of the issues that Senator Joe Manchin, who came out and said that that bill was dead, but that he can get on board with some of these climate initiatives. So potentially this could put the impetus on Congress to move more money to some of those renewable agenda.
Great reporting, AMH. Fantastic work. Thank you very much indeed for joining us to update us. Bloomberg's Anne-Marie Hordern joining us out of Washington, D.C. As we've been indicating, President Biden set to announce those actions that Anne-Marie has been discussing. We think that's going to happen later this hour. Time always a little bit flexible when it comes to these sort of events, but when they do happen, when the president speaks, the remarks on Russia that he's going to deliver, we will bring them to you. I just want to update you on some headlines that are coming out right now. The UK is to produce a ban on Russian oil. That will include refined products and crude. So we'll get some more details on that coming out of Whitehall, I would expect, over the last few minutes. You've also got the National Intelligence Director in the United States. He's speaking at a hearing right now, talking about Russian forces are acting with disregard for civilian lives. Russia is loosening the rules of engagement. Russia encountering serious military shortcomings. You've also got, and this is another story that's worth referencing, Frans Timmermans of the European Commission. He's the European Green Deal European Vice President. He's holding a press conference right now. He is indicating that actually the EU has no plans to sell debt to finance the energy issues that we are encountering right now. So a number of different headlines breaking at the moment. We'll continue to keep you updated. We'll move towards those presidential comments that are coming up very shortly. In the meantime, let's check in with the Bloomberg First Word News. Here with that, Bloomberg's Radhika Gupta.
Thanks, Guy. The European Union is set to propose a new round of sanctions that would target a total of 14 individuals, including a number of wealthy Russians and their family members. But Bloomberg has learned the measures will stop short of more far-reaching steps like penalizing ports. The EU package being considered also includes cutting off 3 Belarus banks from the SWIFT international payment system. And the price of wheat fluctuated near an all-time high after exceeding levels seen during the global food crisis back in 2008. Traders are assessing the impact of Russia's war in Ukraine that's effectively cut off more than a quarter of the world's wheat exports. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Radhika Gupta. This is Bloomberg. Kaylee.
Radhika, thank you. Well, still ahead, we'll talk clean aviation. Fortescue and Airbus are teaming up. We'll talk with the company's chairman of Fortescue, that is Andrew Forrest. This is Bloomberg.
So Frans Timmermans, who is the European Vice President at the European Commission for the European Green Deal, there's a lot of Europeans in there, aren't there, is holding a press conference right now. Some possibility we may get to talk to him a little bit later on. Asked about this Bloomberg report, which we put out a little bit earlier on, talking about the fact the EU is looking at the possibility of using joint debt once again, this time to raise money for financing A, the energy costs of what is happening with the Ukraine war and the impact on Europe, and then the rearmament story. Timmermans talking about this, basically saying at the moment there are no plans to sell debt to finance this energy story. So what you're seeing now is a reaction in the BTP Bund spread. You're seeing Bund yields coming down a little bit. They were very elevated a little bit earlier on in reaction to this. So hopefully we'll get an opportunity to catch up with Timmermans very, very shortly, Kayleigh. We'll see what happens there, but certainly a market reaction to these headlines over the last few minutes.
Just as there was a market reaction to the headlines on the initial Bloomberg report. And of course, this follows the Russian threat to potentially cut off gas flows to Europe. Now the U.S. and U.K. looking at banning Russian oil imports. We're talk more about the energy implications. The International Energy Agency is ready to recommend another release from emergency oil stockpiles if it's needed. We'll have more of our interview with the director, Fatih Birol, next. This is Bloomberg.
Web. This is Bloomberg.
We're about an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is watching the moves. Abigail, you got some action in stocks, but a lot more in bonds and commodities.
Much more so in bonds and commodities. And here's the commodity side of it, Kayleigh. But up top stocks, some volatility there because, of course, the S&P 500 and the NASDAQ 100 earlier higher, now down about 0.7% and 0.9% respectively, having everything to do with the continued surge in commodities that Kayleigh was talking about, in particular oil. Of course, the UK banning oil imports from Russia. That that hitting, or I should say, sending oil higher, hitting it to the upside. And of course, the expectation, the Bloomberg exclusive earlier, that President Biden expected to announce a U.S. ban on Russian imports of oil as well. So oil higher, stocks lower. It shows sector-wise, too. If we go into the Bloomberg and use the IMAP, we are going to see that most sectors are lower. On bottom, healthcare, information technology, and consumer staples. Now, we are off the lows. At the lows, more sectors were down 1%, but there's one clear winner. That is energy, up 3.9%, heading to another big up year. Of course, the top sector last year up more than 45%, up in a big way. And if we take a look at oil, Guy, it's just incredible. How long can this surge go? Because, of course, oil right now at its highest level since 2008. So you can see over the last roughly 5 years, oil had sort of flatlined, let's call it. There had been that volatility, of course, in 2020, but it looks like nothing relative to the upside volatility that we have now. Here is a true parabolic uptrend. Take a look at this. It is straight up, as in a needle higher. Physics, a 90-degree angle cannot hold. So at some point, this is going to collapse. But Steve Sosnick over at Interactive Brokers, he makes the great point that markets can stay irrational longer than some investors can stay solvent. So it's hard to know when this will collapse, but that cannot hold, Guy. At some point, we're going to see all of this move back to the downside. Stay tuned for more volatility ahead.
Yeah, where does it come down to, I guess, is the question. Are we going to be in a situation where we're going to have to live with more elevated oil prices going forward? You take a look at the contract table, you look at the curve, we're $100 plus for quite some time in terms of the way that the curve is structured right now. The price of crude, Abigail, looks certainly to be a huge factor going forward from here in terms of the global economy. The Bank of America now warning that we are in what it calls an ugly scenario. Brent potentially could be peaking at $175 a barrel. Think of Abigail's kind of vertical line here. The IEA saying it's ready to recommend that member countries do release more crude from emergency stockpiles if needed. Are we at that point already? Here's what some people on Bloomberg have been saying to us about this story.
The amount of stocks we release as of last week was only 4% of our stock reserves. There's a lot of oil there, and it will be at the disposal of the markets in order to help to stabilize the markets. But I should tell you that I am rather disappointed with the several producing countries who did not take the necessary measures to comfort the market. Those colleagues, those countries who said they are there to stabilize the markets, we have not seen that recently, and I would say this was really disappointing from my perspective.
Yeah, why is the IEA then not pressuring Saudi Arabia more to increase production, or is that happening behind the scenes?
So we are talking with all the countries around the world. We are reminding them that if the markets, the turmoil continues, it is not in the benefit of anybody, as I see now, but it is of course up to them to decide. I think the previous colleague you talked with saying that there was not enough spare production capacity. This is not right. There is significant amount of spare production capacity, and one may take some of them, bring it to the markets. And I would also tell you that we are very soon going to come up with some suggestions how to reduce the oil demand in a hurry. What we can do there on the demand side, some regulatory voluntary measures that the governments can take, the consuming countries, to reduce the demand, in addition to the possible impact of the high oil prices on the demand growth.
That was IEA Executive Director Fatih Birol speaking with Bloomberg's Francine Lacqua earlier. And Guy, while we were listening to that interview, interestingly, we're starting to get some headlines out from the Uniper CEO, Klaus-Dieter Maubach, who's speaking in an interview, and he says that they're following German government guidance to avoid a supply crisis, and Germany has told the company it can buy more Russian gas. And to me, Guy, this gets to the root of the question: is Germany, and then therefore the rest of Europe, going to get on board with a potential embargo of Russian oil and gas, as we're seeing the U.S. and the U.K. set to make those moves?
You go into the tables of the exposure that European countries have to Russian gas, and places like Bulgaria, it's 100%. Germany's at around 50%. Some of the Scandinavian countries are a little bit higher. Changing that on a dime, really not possible. And yes, there are reserves, and Uniper's talking about that, but we need continued flow of Russian gas into these economies. It's interesting that Gazprom is also out within the last few minutes, or we have had confirmation within the last few minutes. The Gazprom has booked extra Yamal link capacity into Germany for Tuesday, i.e. there's more Russian gas, Kaylee, coming into Europe right now. The flow has not stopped. Really difficult. We were talking earlier on in the program about the impact that gas flow stoppages would cause to the European economy. We're circa 4% in terms of the numbers that the European Commission is expecting for growth this year. That number would be massively lower. Already is probably going to be massively lower as a result of what is happening. But you cut the gas off, then we may have a much worse situation.
Yeah, absolutely, because while Europe is trying to transition to renewables, it is a transition, and thereby it takes some time.
Yep.
So coming up, we're going to talk more about that. The European Union is warned that it must speed up its green transition so that it can rely less on Russian energy. We'll be talking with the EU Commission First Vice President Frans Timmermans next. This is Bloomberg.
Let's check in on the Bloomberg First Word News. I'm Rishika Gupta. The Iran nuclear talks have been thrown into confusion by a demand from Russia. Moscow wants a U.S. guarantee that sanctions over the invasion of Ukraine won't affect its work with Iran. Last week, diplomats from most sides were saying a deal was just days away. Hong Kong reportedly may drop mass testing as a coronavirus priority. The newspaper Mingpao says that instead, the priority may be placed on reducing deaths from COVID. According to the report, the potential shift comes after the leader of China's COVID response team visited China. And the London Metal Exchange halted trading in its nickel market after that unprecedented price spike, nickel rising by as much as 250% over the past 2 days alone to hit record highs above $100,000 a ton. That left brokers struggling to pay margin calls against some deeply unprofitable short positions. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Guy.
Ritika, thank you very much indeed. Let's get more on that unprecedented spike that we are seeing in the nickel market. Bloomberg's Joe Doe, who covers metals and agriculture for us, joins us now. Joe, do we know when this market is going to reopen? Do we know how long it is going to take to sort out what has happened with this short position, the margin calls that go with it, and whether ultimately they do get paid?
Yeah, I think the short answer is we don't know exactly when this market might open. Earlier today, Javier Blas, one of my colleagues, was saying that his sources were telling him, you know, it could be the exchange for nickel will probably be closed tomorrow. It's uncertain after that. It could extend that long. I mean, we're really in uncharted territory here. I hate to use the words, but that's really what we're talking about. I mean, waking up, at 1 a.m, seeing prices going from 60 to 80 to then $100,000 a ton was unbelievable. And now that the market is trying to unwind and figure out what's going on here, I think that's really the most important thing at the moment.
Well, Joe, actually 1 a.m. is about the time I was waking up, so that was indeed true for me. Obviously, what we're seeing in nickel is pretty detached from the fundamentals here, but for some of the other metals, we have also seen really incredible rallies, and I'm wondering if that is actually more reflective of reality.
Yeah, I mean, on nickel, I think you nailed the point here, which you're hearing from everybody, from analysts to traders. It's not a fundamental move, right? This is a large short squeeze, and we had reporting from my colleagues Alf Song and Jack Farchi, who, according to sources, were saying that this was Tsingshan, the largest nickel producer on the planet. They had a massive number of short positions that they're trying to cover. With other metals, you know, this is very much getting back to the fundamental play. When Russia is no longer, you know, a normal actor in the world for financial markets, the questions become, well, can we continue to do business with them? I mean, they are a massive producer of nickel. They are a massive producer of aluminum. They are in every bit of this. And for traders right now trying to determine if business that they've just expected to flow through Russia, like literally flow through Russia, can no longer be a part of their plan, I mean, that's really what you've been seeing now for the past 2 weeks.
Joe, commodities are often used as collateral. Is the market functioning properly? Is there a collateral problem here? Some of these assets are very hard to value right now, and their use as collateral therefore needs to be questioned. Is there a liquidity problem that could ultimately flow from this?
I think this is a real discussion happening in various circles throughout the market globally. I think in nickel, obviously, this is the big question, right? I mean, nickel's just like in a totally different stratosphere. I mean, I was talking to one aluminum trader just yesterday who said, listen, with aluminum, we've seen it go to a record, but a lot of people had at least put on some hedges that a crisis could happen. Maybe not to this level, but they expected maybe something bad could happen. So I think, you know, again, to be clear, when you're talking about liquidity in market, this is some very serious stuff. Yeah. I think with nickel, we obviously have a problem that needs to be sorted out. With many of the other metals, I'm not so sure that we're quite there, and I don't know if that's something that the traders are as worried about.
Well, Joe, this may be an unfair question, but how was the LME not prepared for this kind of scenario? I mean, literally, how did this happen?
Yeah, I think a lot more reporting is going to have to be done to figure out, you know, really what was what behind all of this. I mean, people have been referring to the tin scenario that happened back in the 1980s, which was kind of the LME's darkest moment. You know, I think there's just there's so little clarity as to what happened and why it happened so quickly. And to finally get down to, how the LME acted or did not act, I think there's more to see to come on that one.
Joe, really interesting reporting. We've been all glued to this story over the last 24 hours. Bloomberg's Joe Doe, thank you very much indeed. This is Bloomberg. So let's talk about the energy transition from a different perspective. Clearly, high energy costs are forcing a rethink of a number of different strategies moving forward in terms of energy transitions. Fortescue, the mining giant, and Airbus, the aviation giant, teaming up to help decarbonize aviation. The companies have announced today that they'll be working together on a plan to use green hydrogen-based aircraft. The plan to be in place by 2035. Joining us now is Andrew Forrest, Fortescue Metals Group Chairman. Andrew, thank you very much indeed for your time today. The events of the last few days have in many ways changed a lot of people's perception of the energy transition. Natural gas prices in Europe going through the roof. We're seeing metals prices going through the roof as well. We've just been talking about what's been happening in the nickel market. How much does a plan like the one you've proposed today continue to stack up as a result of the shifting prices that we're seeing for these key components that are going to go into this energy transition?
That's a great question. Green hydrogen, green ammonia, green electricity was really competitive before, but there was resistance. We're finding that resistance now falling away as everybody now understands we have to get off fossil fuel. We have to become energy independent. In Europe or North America or Australia, you have the opportunity now to become fully energy independent because you have green energy on your doorstep, over your head, all around you. Now's the time to tap it.
Okay, Mr. Forrest, and that's obviously a very admirable goal, but at the same time, when it comes to green hydrogen in particular, it takes a lot of energy and a lot of capital in order to produce it. I've read estimates that an $11 trillion investment in production and storage worldwide would be needed through 2050, and more electricity than the world generates now to have green hydrogen meet a quarter of the world's energy needs. Do we literally have enough energy to produce this alternative form of energy?
Yeah, so we need to break through that thinking. Green energy is easily the cheapest and getting much cheaper form of electricity or of energy than the world has ever seen. So we're going to be able to produce way more energy than we ever have in the past, and we're going to do it without a molecule of carbon or its big ugly brother, methane, into the atmosphere. These are great points you're making, but put it in the frame that the abundance of energy, which is green and commercial, is thousands of times more than humanity will ever need.
But in order to get there, and in order to get there quickly, Andrew, we are going to have to build a lot of wind turbines. We're going to have to do a lot of things that are going to be incredibly expensive. The price tag for producing this energy is going up and up and up. Ultimately, once built, the energy is very, very cheap and has a very low carbon footprint. But to get to that point appears day by day to becoming more and more expensive. I listened to the Vestas CEO talking about the input cost issues that he's facing in terms of building wind turbines. The problems are mounting. Are the timelines and the cost estimates currently realistic?
Well, look, I could not more virulently disagree. If you're looking at time and money, then I can tell you green energy is so much simpler than building a great oil and gas refinery or trying to put in a nuclear power plant. Hey, I'd rather put in a few solar panels and wind turbines than those honking great smelly things. We're getting approvals fast, we're getting capital fast, and just think of this. We're one company. We've committed to 15 million tonnes of green hydrogen by 2030. That would take out all of Germany's reliance on Russia today. We've started work on this 2 years ago. We're full steam ahead and we're just one company.
Yeah, obviously that partnership with Airbus really focused on research and development. I'd want to get to the heart of what Fortescue's original business was, though, and that was metals. We were just talking about what we saw with nickel today, the LME actually having to close the market due to that short squeeze. Obviously, those prices going up dramatically. Nickel is crucial when we think about electric vehicles, when we think about lithium-ion batteries. How does the metal supply factor into the ability of this green transition and maybe the inability to accelerate it at the current moment?
Recycling. We have in Fortescue Future Industries, we're a wholly owned part of Fortescue Metals Group, as you pointed out. We're already Australia's top performing company for shareholder returns by several times in the last 20 years. We're going to continue that energy, that talent, that growth. We're putting it all into renewable energy. We will be the world's first fully integrated resources and renewable energy company. So when you're talking lithium, when you're talking iron, when you're talking nickel, we expect to be a one-stop shop for that and your hydrogen and your ammonia and your green electricity. So we don't see it as the challenge you do. We have these exploration targets, we have these projects, and we're just getting on with it. We will be able to meet the world demand. Yes, commodities go up and down in price, but consistency of supply just continues to grow on a very solid path, and we'll be helping that path along strongly.
Andrew, on a day like today, I'm really happy to hear your optimism, because certainly we are in need of such optimism. Andrew Forrest, Fortescue Metals Group Chairman. Sir, thank you very much indeed for your time. Let's talk a little bit about what is happening over the next few minutes. In theory, we should currently be listening to President Biden talking about an energy embargo on Russia. I suspect the President will be speaking probably in the next hour. The EU, though, is not going along with the US and to a certain extent the UK's decision to limit Russian energy supplies into its economy. Let's talk a little bit about that right now. And the plans maybe to lessen the impact of Russian energy into Europe. Frans Timmermans joins us from the European Commission. He's effectively in charge of the European Green Deal. He's a European Vice President at the Commission. Commissioner, thank you very much indeed for taking some time to talk with us. I know you've had an incredibly busy day. In the next few minutes, President Biden is going to announce a ban on Russian energy into the US economy. Is the EU in a position to be able to replicate such a ban? Would such a ban be possible?
I have just announced in the last hour that we will reduce our gas imports from Russia by 2/3 before the end of this year. So I think that's a substantial contribution to increasing our energy sovereignty. We will still be looking into the oil markets. That is something that's still on the table, the possibility of sanctions there. This is something that will be discussed by our leaders next Thursday and Friday in Versailles, near Paris. Nothing is off the table, but we're not taking the same decision as President Biden Biden apparently is taking today, but we have announced today that we will reduce our natural gas imports by 2/3 before the end of this year.
I'm wondering about the funding to do so, Mr. Timmermans. You said earlier when asked about the Bloomberg report about potential joint debt issuance from the European Union to finance energy and defense, you said that the EU has no plans to do so, to sell debt to finance energy. How then do you make this transition and shift away from that dependency on Russia?
First of all, a lot of what we're doing is already in our plans that we've presented in our recovery and resilience plans that we've discussed with our member states. But I'm sure that our leaders will come back to the issue of financing also next Thursday and Friday, because it's clear to me that this enhanced energy transition that we will now be going through, the need to revisit some strategic choices we need to make. You know, the world has changed on the 24th of February, and we need to bear the consequences of that, and that will also have financial consequences, but this is something typically for our leaders to discuss later this week.
So you are not saying that this is off the table. It potentially could be discussed, some sort of joint financing to deal with the current energy crisis that Europe is facing could potentially be discussed in Versailles. You're not saying that that is not going to happen?
Well, it depends on what the French presidency will bring to the table. But let me be very clear. We don't have the luxury anymore to say that anything's off the table as of the 24th of February. We're confronted with a Russian leader who has invaded a neighboring country, a democratic country, a country that shares our values. This is a threat to our collective security, and you know, I'm really happy that we've found such common ground with our transatlantic allies, and that we've been working. You know, Putin tried for 20 years to create division in Europe, to create division between the US and Europe, and he's failed completely. We're more united than ever before, and which also means that we don't have the luxury to say that some issues would be off the table. We need to be able to confront everything, and there should be no taboos also in